Welcome back to Alpha Recap, your weekly market digest from stockalpha.ai. I'm so glad you're with us. We closed the week, and markets were closed for the weekend. So today, we're unpacking the big themes from the research published May 11th through 17th. As always, if you have questions, you can reach us at stockalpha.ai and even ask follow-ups in our Q&A. Okay, let's jump in.
Thanks for having me. Lots to cover this week. The headlines really boil down to two competing forces: accelerated AI monetization across software and services, and a simultaneous valuation reset in several large names. The push and pull between those drove a lot of the notes we saw.
Totally. So, what really stands out here is AI everywhere, but some stocks are getting punished, or at least repriced. Walk me through the big picture takeaway first.
Sure, in plain terms, analysts saw AI features acting like revenue multipliers. Things like higher average revenue per customer, more product-led expansion, and in some cases, margin lift through automation. At the same time, a number of large cap names were trading below past highs or lower than normal multiples, which created tension. So the narrative was, AI can accelerate top line, but high multiples make stocks more sensitive to small misses.
Yeah, that tension kept popping up in the notes. Give me some company-level highlights, short and sweet.
Okay, Nvidia was front and center ahead of earnings on May 20th. Analysts had raised targets, and the company continued to be framed as the AI accelerator leader, driving outsized revenue and margins. Nvidia finished the period around $225, with a price-to-earnings ratio near 45. High, but justified in analysts' view by the structural demand for accelerators.
Right, and that earnings print was flagged as a big catalyst.
Exactly. Then in software and communications, you had a handful of examples. Twilio was near its 52-week highs after its Signal announcements and a strong first quarter beat. That pushed average revenue per customer higher. But the price-to-earnings ratio was massive, roughly 290. So analysts flagged limited room for error there.
290? That's wild.
Yeah, that tracks. DocuSign was embedding AI into its platform, contract assistance, and broader agreement management, and analysts saw improving revenue momentum and operating leverage. DocuSign finished around $48, and the analyst sample implied roughly 25% upside to a mean target near $60.
And you said something earlier about Globant. That was an interesting mix, right?
Globant reported an AI-driven revenue beat tied to its AI pods model, which lifted sentiment into the long weekend. But the company also missed on earnings per share recently, and analysts trimmed price targets. So the takeaway was, product traction is visible, the execution variability and macro sensitivity left the risk-reward ambiguous.
Oof, not a great day for some of those growth names.
Right. Bill Holdings beat its quarter with AI automation helping both revenue and margins. Analysts noted about 38% mean upside in their sample, though it's still a smaller cap growth profile with macro sensitivity. Okta is extending into AI identity work and could broaden its addressable market, but it was trading at a price-to-earnings ratio near 62, which left analysts with a neutral stance ahead of May 28th earnings.
Plugging a little data gap in here. Splunk's note was kind of unique.
Yes, the Splunk research explicitly flagged missing public financial data in the dataset used by analysts. The stock was quoted around $157 as of mid-May, but key market cap and earnings details were incomplete. So rather than project, analysts assigned a neutral stance pending corporate disclosures. That was a deliberate, conservative approach.
That feels responsible. Don't guess when the data's missing. What about healthcare names?
Two different stories there. Eli Lilly reported a strong first quarter beat and positive late-stage obesity results. The obesity franchise was framed as a multi-quarter growth driver, though pricing and competition remain risks. Lilly finished around $1,005, with a price-to-earnings ratio near 37. Intuitive Surgical showed renewed procedure growth tied to the Da Vinci 5 upgrade cycle and had a strong beat as well. Shares were trading around $421, with a price-to-earnings ratio near 50, and analysts stayed bullish, albeit noting the premium multiple.
And Danaher?
Danaher was the contrarian value angle. It traded near a 5-year valuation low despite an earnings beat in the first quarter. Price was about $162, and the price-to-earnings ratio was roughly 31. Analysts saw durable bioprocessing exposure and set a mean target near $246. So some saw optionality if bioprocessing demand re-accelerates.
That's a big implied gap. Okay, let's zoom out. What patterns connected these notes?
3 big patterns. First, AI as an incremental revenue source was ubiquitous, across software, communications, and even infrastructure. Analysts were focusing less on pure recurring revenue and more on average revenue per customer and feature monetization. Second, valuation dispersion was stark. A few premium growers were richly valued, while some durable names were trading at multi-year lows. Third, event-driven volatility mattered. Upcoming earnings or clinical readouts were positioned as potential re-rating catalysts because high multiples compress the margin for error.
Explain that ARPC concept in simple terms for listeners who might not be deep in the spreadsheets.
Sure. ARPC means average revenue per customer. Think of a company that has a steady base of customers. If it introduces AI features that existing customers pay more for, that lifts the average money each customer pays without necessarily adding new customers. It's a way to grow revenue faster than just selling more seats. Analysts are increasingly tracking ARPC, feature adoption, and expansion rates as the real signals that AI is translating into dollars.
Got it. So what were the key event dates to watch that folks should have noted?
High leverage dates were highlighted. NVIDIA's earnings on May 20th, Okta on May 28th, and DocuSign on June 4th. Those prints were flagged as potentially material, given the momentum in AI features and compressed multiples on some names. Analysts also emphasized watching early post-earnings reads on ARPC and expansion metrics across Twilio, Bill Holdings, DocuSign, Globant, and Okta.
Short reactions. Right.
Yeah, that tracks.
There were also some contrarian takes in the research. Which stood out?
Danaher was the clearest contrarian call, strong buy from several analysts despite the valuation reset. Twilio was another. Clear product momentum, but a stretched multiple created a momentum meets froth narrative. And Splunk's neutral stance because of missing data was itself contrarian. Rather than speculate, analysts waited for better disclosures.
Practical and cautious. For listeners who want to build a watch list from this, what were the concrete KPIs analysts wanted them to track?
Analysts suggested a handful of operational indicators: ARPC changes, net expansion rate, feature adoption metrics, gross retention, order book and backlog for industrial and medical equipment, weekly or monthly revenue cadence for healthcare launches, and any guidance or supply commentary in earnings calls. Also track valuation dispersion, price-to-earnings ratios versus historical ranges, because those determine how sensitive stocks are to new information.
Quick question on methodology. The notes use scenario analysis a lot, right?
Yes. Because high multiples amplify misses, analysts tended to run upside and downside scenarios rather than single-point forecasts. They also stressed data quality. The Splunk example showed how incomplete inputs materially increase uncertainty. So some analysts prefer to wait for company disclosures instead of extrapolating.
We always have to throw in the legal stuff. Remind listeners about the disclaimer.
Important to repeat. This is informational analysis only. Analysts note trends and scenarios. This is not a recommendation to buy, sell, or hold any specific security, and it's not personalized financial advice. Readers should do their own due diligence or consult a licensed professional.
Short reactions.
Make sense?
Totally.
Yep.
Before we wrap, give listeners 3 clear takeaways they can remember from this week.
1. AI is materially reshaping revenue models. Beyond new customers, feature monetization is lifting average revenue per customer across many software and communications names. 2. Valuation dispersion matters. Premium growers can stay expensive, but other durable businesses are trading at lower multiples, opening different kinds of opportunity and risk depending on execution. 3. Watch the event calendar and operational KPIs closely. Because multiples are elevated, short-term prints and adoption metrics can materially re-rate momentum names.
Great summary. Any final quick tips for the week ahead?
Track the NVIDIA print and look for segment revenue and supply commentary. Monitor early ARPC reads in post-earnings slides for the software names. Watch Okta and DocuSign for adoption signals. And keep an eye on healthcare commercialization cadence and manufacturing notes for obesity therapies. And remember to check data completeness before relying on a single desk estimate.
Perfect. Thanks for the clear breakdown. If you enjoyed this, remember to send your questions to stockalpha.ai. You can ask us directly in the Q&A, and we'll answer live. For more market analysis and insights, visit stockalpha.ai. That wraps today's Alpha Recap. See you next week.